Okay, we're going to get going. Thank you for joining us today. Welcome to Financial Insights Wealth Management second quarter Wisdom and Wealth series with Amanda Nathan of Gordon Thomas Honeywell, speaking on estate planning basics for individuals and couples over 2 million. For those who don't know me or Financial Insights Wealth Management, my name is Allie Kemp, and I'm the CEO and a wealth advisor at Financial Insights. Financial Insights has been providing wealth management services to clients since 1981 and are proud to be a local area resource for retirement, investment, tax, and estate planning for our high net worth clients. This is our 5th year providing educating content to clients and local area professionals, and I'm happy to report we are now a CFP CE sponsor through the CFP Board of Standards. Please provide our office with your certified financial planner number to receive 1 hour of continuing education credit for today's session. Please join in and mark your calendars for our next Wisdom and Wealth session in person and at our offices with Alan Hensley, CFP, on cybersecurity on September 25th. This session is being recorded, and we will have a question and answer session at the end, and Amanda has offered to take questions throughout the session. So if you look at the bottom of your Zoom screen, you will see a chat function and a little bubble. If you do have some questions throughout the session, please feel free to type your question into the chat. We will review them, and either myself or Amanda will read them off, and they could be answered either throughout the content or at the end of the session. So thank you so much for joining us. And now to announce Amanda Nathan. Amanda Nathan is a partner at Gordon Thomas Honeywell and chair of the Trust and Estate Group. A third-generation Tacoma native, she maintains strong ties to the South Sound community and serves on the board of trustees of Tacoma Arts Live. She is passionate about designing and implementing individualized estate plans for her clients, focusing on reducing state and federal estate tax liability. Outside of her professional life, Amanda enjoys exploring parks around her Bainbridge Island home and her family with their rescued German Shepherd. She also takes opportunity to indulge in her love of skiing. Amanda earned her BA from Willamette University and her JD from the University of Washington School of Law, where she also completed several LLM courses related to estate and gift tax. So no further ado, in introducing Amanda, thank you so much for joining us today.
Thank you, Allie. I am really excited to be here. And a couple of things before I jump in today. One, I talk really fast. I'm going to try very hard to not talk really fast, but if I get going and you have a question, feel free to pop into the chat, ask me to repeat something or slow down a little. I understand. Also, let me see if I can get going on my screen sharing over here. As Ali mentioned, I'm going to be covering quite a bit of ground today, and we have an interestingly broad audience. I think some of you are sort of interested in this information for your own use. I think we have maybe some CFPs with us today who are also getting some education credits. So there are some details in my presentation that might not apply to all of you, and I just, stick with me. I'm going to try to make this interesting for everybody. I think it's really exciting and interesting. I realize that not everybody shares my passion for estate taxes. So I shouldn't say for estate taxes, for estate tax planning. So without further ado, I'm going to screen share and we will jump in. Okay. Hang on, we practiced this. I know I can do this. Okay, is that looking good to everybody? Allie, give me a thumbs up. Okay, thank you. So we are focusing today on the way I'm phrasing that the title is Estate Tax Planning Basics for Washington Residents. It's basically the same thing Allie said, but we wanted to make it clear that this is going to be geared at those of you, single, unmarried individuals with 2 million and up, or married couples with 2 million combined net worth and up. That's where the reason we set that number up there is that is essentially the threshold at which Washington estate tax becomes a factor in your planning. That will be my focus today. I'll talk a little bit about federal estate tax planning as well, but we'll see how far I get with my slides here, and I'm going to focus more on the Washington side of things. So overview. I am not going to get too much into the nitty-gritty of what estate planning is, but of course, some of us are more familiar with it than others. So I'll give you a brief introduction to what I consider to be part of an estate plan. I think it's always a good idea to just let folks know what are some red flags that I look for. What are the times that if I'm talking to somebody, I think, okay, we need to dig into this a little more. That would probably be a good reason to at least review your documents, if not update them. So I'll give you a sense of some red flags. And then we will move into estate taxes. I will briefly introduce the concept of federal estate tax versus Washington estate tax, and give you some sense of the key concepts in our estate tax planning. We'll talk about your federal and your Washington estate tax exclusions, how they differ and where the overlap happens. We'll talk about two of the primary tools that I use a lot in planning for our clients, which is marital deduction planning and the charitable deduction planning, another passion of mine, which we didn't mention in my bio, but I really enjoy working with clients on working on furthering their charitable goals. So I will definitely touch on that a bit today as well. And last but not least, I will give you some examples of tools that we use for lifetime tax saving gifts. There's a whole bunch of ways to do your gifting, and I'll give you just a brief idea of some of the things that we tend to talk about with our clients. What is estate planning? I think sometimes folks think when they hear estate planning that it's really about planning somebody's estate, like after a death, but actually estate planning is something you do during your lifetime to plan for several things. During your lifetime, your estate planning will include documents that will help you if you are ever incapacitated. For example, your powers of attorney for financial and healthcare. Those are two of the most important. Sometimes one document, but we break them into two. Two of the most important documents for you during your lifetime to make sure that somebody, the right person, is empowered and authorized to act for you during any period where you're not able to manage your own financial assets or communicate your wishes regarding your healthcare decisions. So those are your powers of attorney. That's part of your estate planning. And also we're planning for what, of course, happens to your assets after your death. It's not just your assets, though. It's I talk a little about, your other responsibilities. That's if you have young children that you're responsible for, if there are family members with special needs for whom you are providing care. Those are things that we talk about as part of your estate planning. We discuss estate tax liability. Some clients are more concerned about that than others, but that's something I personally spend quite a bit of time working through with my clients. And above all, I would say shaping your legacy. What is the legacy that you are leaving for your children, for your community? And there's so many ways to look at what that might mean something different to each of you. But that's a big part of, I think, the opportunity you have with good estate planning. I wanted to direct you, many of you may have actually attended one or more of these presentations, but Allie and her group have several recorded presentations from past iterations of this series. And I think the two that I noticed, Annie Arbens and Brianne Campbell, who are both Tacoma estate planning attorneys, have actually done presentations on sort of an estate planning 101 basics that might be of interest to you if you want to delve in greater detail into any of these ideas that I just mentioned. Red flags. And you'll hear more about these if you are listening to Annie or Brianne's presentation. But estate tax planning, as I mentioned, that kicks in when we see somebody with net worth that exceeds 2 million or approaches or exceeds 2 million. They're getting into Washington estate tax territory. And that's true for a married couple with 2 million or a single person with 2 million. And I'll tell you more about why we don't just double that for a married couple. If you don't have a will or a revocable living trust, then people say, well, I don't have an estate plan. Well, you do have a plan. The government has made a plan for you. It might not be the plan you want. So good to sort of talk through with someone what is actually going to happen when I die. What happens if I don't make a will? If you don't have powers of attorney, I mentioned that really could put you in a difficult spot if you're ever incapacitated. And that's one of the most important pieces of your planning. Keeping those documents current is also a good idea. I try to encourage folks to update your powers of attorney at least every 10 years, but the law changed fairly significantly in that area, about 2018. So if you haven't updated them in a while, you should freshen those up. If you own out-of-state real estate and it's owned in your name, even a fractional interest in out-of-state real estate can be a kind of a beast to deal with after you pass. There are ways to deal with that more gracefully, one of which would be a living trust. There are other options, but it's worth talking to an attorney about it. If you are a business owner and you're planning to retire in the next few years and you want to sell your business, that's a great time to do some planning before you get too far down that road. And a list of other hot spots. You might notice that there's a lot of things in here. Stepchildren, no children, disinheriting children, children with special needs or other considerations. Children in general always generate interesting conversations. And of course, planning for your own incapacity or for your spouse's incapacity. If there's a history of dementia or Alzheimer's in your family, for example, sometimes that we might sort of adjust our planning, thinking that we might be wanting to think ahead about the transition of how your assets will be managed if you start to have capacity concerns. All right, I promised a presentation on estate taxes. So any comments or questions so far? Seeing none, I don't think I see any. Hang on, let me make sure I can see this chat bar. Can somebody
No, there are no
Allie,
questions
none?
yet,
Okay.
Amanda, you're all good.
Thank you. I don't actually know if I'll be able to see it if I have one, so please.
I'll keep an eye out for you.
What is estate tax? Sometimes we talk, clients will refer to that as a death tax. I say estate tax, but essentially it is a tax imposed on assets that are transferred after a death. It is a tax paid by the estate, not by the recipients of those assets. And it includes pretty much everything, including some things that you might not have thought about as being part of what, the decedent's assets. So the obvious things are bank accounts, vehicles, things that are actually titled in the decedent's name. It also includes all the assets titled in the decedent's revocable living trust. Now, in some cases, we'll see living trusts where it's a joint married couple that has one living trust and it's funded with a bunch of community property that's owned by both of them as a marital unit. In that case, it includes 50% of all of that community property, whether it's titled in their names or in their living trust. And often I hear clients say, well, my husband's name isn't on that account, so why would it be part of his estate? Well, if it's your community property, which tends to be a presumption it's community unless you've inherited it or brought it into the marriage and not added to it after your marriage, or you have a prenup or a post-nup agreement, the presumption is likely that it would end up being treated as community property when either of you passes, and that would pull 50% of that asset into the taxable estate. It also includes non-probate assets. So those would be things like your retirement accounts, 401ks, 403bs, IRAs, Roth IRAs. It includes life insurance. If the policy is paying out upon the death, if the decedent was actually an owner on the policy and it's paying out to their spouse, but it was a community property asset, those proceeds will get pulled into the taxable estate. 50% of the community property proceeds of the life insurance get pulled into the estate. And it also, this is a little more of a nuanced one, but it could also include assets that were actually, maybe you don't think of them as being your assets, but or the decedent's asset, but if the decedent had a general power of appointment, that's definitely a legal term of art, but in essentially, if somebody has funded a trust for your benefit, it's possible that you have a general power of appointment that would actually result in those trust assets being taxed in your estate when you die. And that's something your attorney would definitely want to know about, any trusts that have been set up for you, of which you're a beneficiary. And it can come up in other contexts as well, but that's the one I see it in most often. Any questions? Okay. All right. Here's a bird's eye view of federal estate tax planning. This year, 2024, each of us has an exclusion of $13,610,000 from federal estate and gift tax. So that's a unified credit towards your estate. That's a unified exclusion for your federal estate and gift tax. That number is indexed annually for inflation. So each year it has been growing fairly rapidly over the last few years as inflation has been high. And unless you filed a gift tax return and reported some large gifting in the past, you have all $13,610,000 to work with this year. If you make some big gifts, you use a little bit up during your lifetime. That just means you have less to use when you die for your estate. Any assets you own that exceed your exclusion when you die that are still in your taxable estate will be taxed at a rate of 40%. So that definitely gets people's attention. There are I said mention it, if it only applies to large gifts, you have an exclusion each year that you can give to any individual without having to report a gift to the IRS. This year, that exclusion amount is $18,000. A lot of folks think of it as $15,000, which it was a few years ago, but right now it's $18,000 because inflation has continued to push that number up. It also, also applies to transfers after death. So whether it's in your estate when you die or whether you make a lifetime gift, you need to be mindful that you have this big number here to work with right now. Generation skipping transfers. I don't want to talk too much about this. This is a really complicated area, but I think you should be aware, especially those advisors in this audience, that if you are making a gift, for example, most often we see grandparents giving gifts to grandchildren or to trusts for grandchildren or to a trust of which both their children and their grandchildren are beneficiaries, for example. Also need to be aware that there's a different tax. In addition to estate and gift tax, we have generation skipping transfer tax, which we call the GST tax. And that rate is also 40%. You also have an exclusion of $13,610,000. If you really blow it and somehow gift more to your grandchildren than you were allowed to, it can become very punitive. Those taxes can be layered. So we do all sorts of planning to avoid accidentally triggering a GST tax. But again, most people here I think won't need to worry about this. I just want it to be on your radar that gifts to grandchildren, the IRS doesn't love it because by giving to your grandchildren, you're essentially skipping over your children's taxable estate, and the IRS doesn't get to tax it when the child dies. So they like to make sure they get their share. Washington estate tax planning. This is a little simpler, fewer bullets on this slide. We each have a $2,193,000 exclusion or exemption from Washington estate tax in 2024 per person. The tax rate is a bit lower, quite a bit lower than the federal estate tax. So it's a graduated rate. The first $1 million of excess above your $2,193,000 exemption would be taxed at a 10% rate after your death. This is only an estate tax, not a gift tax. And then it goes up to 14% on the next million, and it eventually caps out at 20%. There is no gift tax or generation skipping transfer tax, GST tax, in Washington state. So we're only concerned for Washington tax planning. It's only about well, there's a few other things, but the focus would be on the transfers that happen after your death.
I do have
a question. Oh, yep, we have a question. I see it.
Is the yearly gift exemption going to be rolled back from 18,000?
Wouldn't that be nice to know? I'll probably say this a few times today. I don't have a crystal ball. Usually it goes up with inflation. I suppose it could change though. Like any law, they can make adjustments, but I would be surprised to see that drop anytime soon. Please don't hold me to that though, okay? I can't promise anything. Okay, some strategies. When I sit down with my clients, we try to, I tend to assume everybody wants to pay less estate tax. That's generally a safe assumption, but we all have different priorities. And some of the goals that I would say come up most often and that I'm usually keeping in the back of my mind would be for a married couple, deferring the payment of those estate taxes until after both spouses' lifetime. I would also consider if one spouse has passed, especially in certain situations where like maybe the one spouse, maybe it's a blended family where each spouse has children from previous relationships, that we want to preserve the wishes of the first spouse to die about what happens to their share of the assets. And I'll talk more about some of the ways that we can do that. We will also always want to try to fully utilize both spouses' estate tax exclusion so that we can maximize the amount of assets that will eventually go to their heirs, usually their children, but to whomever they've chosen, free of estate tax. So if it's sort of with just a little basic planning, I'm going to call it basic. It's probably not that basic, but with some basic planning, you can do a lot in terms of reducing the amount of estate tax paid. Again, married couples here, marital deduction planning is a big part of what we do. If you are married, you may not know, but you can give your spouse as much as you want without using any of your gift and estate tax exclusion. So there is an unlimited marital deduction from both gift tax and estate tax on both federal and Washington level. You'll see in my examples here in a few minutes, I'm going to show you some examples. We, in our documents, tend to call a tax saving trust. So when one spouse dies, we tend to do the marital deduction planning by funding what we call a marital trust. The marital trust is a tax saving trust funded with the decedent spouse's share of the assets. There are different names for the marital trust. You'll see other documents might call this the exemption trust, the credit shelter trust, the bypass trust, and AV trust. I like calling it a marital trust because it's for your spouse for their lifetime. They are the only beneficiary while your surviving spouse is alive. And so I think marital helps me and my clients keep track of who the beneficiary is. I will also talk a little about QTip trust or a QTip marital trust. It's not like a Q-tip that you don't use to clean your ears. I don't know. But we call it Q-tip, qualified terminable interest property. I'll talk about what that means in a few minutes here. Another way of doing marital deduction planning that we see a lot for clients in that sort of lower Washington taxable range, like the 2 to 4 million range, might be a disclaimer trust plan. And I'll talk more about disclaimer trusts in a moment. We talk quite a bit about lifetime gifting. As I mentioned, Washington does not have a gift tax. So you can basically, if you're doing some smart planning, you can, for many clients, eliminate Washington estate tax by gifting assets during lifetime. And I always want to take the opportunity to remind people that for all the planning we do, it is really important after you meet with your estate planning attorney to sit down and review your beneficiary designations on your retirement accounts and your life insurance, as well as take a look at any other non-probate arrangements you might have in place. So those come up in the context of bank accounts and brokerage accounts that are set up as joint tenant with right of survivorship. That's JTWROS, that's what that stands for. It's a joint tenancy with right of survivorship account. We see that a lot on bank accounts, but I actually saw a couple of large brokerage accounts set up that way today for another client. Payable on death, POD, transfer on death, TOD. Those are things that will happen when one of the account owners dies, whether it's a spouse or a spouse with a child on the account, or a parent with a child on the account. When any of the account holders die, it could trigger a transfer that actually might be completely inconsistent with your estate plan. So it's important to keep an eye on those things and update them when you're doing your other updates with your attorney. Okay, I see a question. Oh, that was the answer. Okay. Any other questions? I'm going to move on. Am I doing on time? I think we're good. Okay. One example. Here is a pretty basic example. So John and Jane have $4 million. We're going to assume for simplicity here that everything is community property, which is pretty common. If you're a Washington resident, longtime Washington resident, all your earnings were earned pretty much after marriage. All of your assets are going to be considered community marital assets. Let's say there's a real basic will leaving everything to your spouse outright if they survive you. So let me get my pointer out here. Okay, so we're here, $4 million. Now the first spouse has passed. we divide these assets into two buckets. We've got the share that belongs to the decedent spouse, which is 2 million, and then the 2 million survivor's share of the community property. With a basic plan, these two shares will actually be merged back into the survivor's estate. So now the surviving spouse has $4 million in his or her estate. And remember, the surviving spouse can change her plan anytime. So she can go change her will and leave things to charity, or to maybe eventually she remarries, she could add her new spouse or stepchildren as beneficiaries of her estate. But let's assume she doesn't do that. When she dies, she leaves everything to daughter and son of Jane and John. And that $4 million estate, it is going to be taxed in Washington because it exceeds the surviving spouse's Washington exemption. Remember, Jane, let's say Jane's a surviving spouse, she has $2 million and change, $2,193,000 of exclusion. But she's got quite a bit more than that in her estate, and the estate tax comes out to be around $240,000, so $250,000 of estate taxes paid. And her daughter and son inherit a bit less than half each of the estate. This is a very simple example, and obviously I'm skipping some expenses that would be paid and other factors, but that's a big tax bill in my mind. Here's another example of how John and Jane maybe could have set up their plan. Let's say here I gave them $3 million in this example, so we're going to have a $3 million estate, but they're still above a level at which if Jane inherits all the assets at $3 million, she's still going to have a Washington taxable estate. In this example, the first spouse has $1.5 million. The surviving spouse would get $1.5 million, but they have a disclaimer to a marital trust option in their wills. And Jane remembers that her attorney told her to go talk to her attorney and come back and talk to them and talk to her accountant before she did any retitling of her assets after her spouse died. So she sits down, let's say I'm her attorney, we're going to talk about whether or not she should make a disclaimer. And a disclaimer is a pretty simple step, but it's actually pretty easy to screw it up. You really have to make a qualified disclaimer of an inheritance within 9 months of the date of death. We decide that Jane wants to take advantage of funding a tax-saving marital trust under her husband's will. He had his option if she didn't think she needed all $1.5 million from his estate outright. She can actually say, I'm going to disclaim it. I'm not going to take that asset outright. And what happens then is we go back to the will and see, what does it say? If Jane disclaims, then those assets are going to go into this, what we're going to call the marital trust. It's really important to note that this marital trust is not locked up forever. This is actually a trust of which Jane is still going to be a beneficiary during her lifetime. Depending on how we set it up, she's probably going to get all the net income from that trust. And it's like her savings account, right? So she'll have her own assets to work with, but if she starts to run a little low on assets or doesn't have enough liquidity, she can actually typically draw assets from the marital trust to pay for things for herself. So it's over here in this marital trust bucket because she disclaimed to the trust. But now when Jane passes, instead of paying $100,000 of Washington estate tax from her estate, she'll pay $0 of Washington estate tax because all those assets she disclaimed to the marital trust are actually going to pass to her kids, to the daughter and son, with no estate tax paid. They are not part of her taxable estate. So it sounds kind of complicated. It's actually, once you get things set up, it's not too hard, but it does require working with, an attorney and usually a CPA involved as well to get this plan executed correctly. Great way if you decide you're like at the cusp of being taxable, but let's say you have a $2.5 million combined estate, you're really not too far over that $2,193,000 mark. You might not want to have to deal with the complexity of a marital trust. And so this gives you some flexibility down the road when we don't know, you might spend down in the next few years your assets and you might give some away to the kids. And then you'll get yourself under $2 million. The surviving spouse won't need to bother with funding a tax saving trust. So I like a disclaimer trust in certain situations where we are confident that the client will also seek counsel, which is really important. Part of this whole thing is getting some help with this process and making these decisions. So there's a disclaimer trust plan that gives some flexibility depending on asset values. And here's a required marital trust. So in this case, we don't have an option for the surviving spouse to disclaim to the marital trust. It's actually required under the first spouse's will. So I'm sorry, I'm picking on John here, but let's say John has passed first. John's estate is we're back to my $4 million example. John has 2 million. Surviving spouse Jane has 2 million in her share. John is going to leave his $2 million in trust for Jane's lifetime benefit in this marital trust. Jane is the sole beneficiary of the marital trust during her lifetime. She gets the net income likely for the duration of her life. And that might be a lot or it might be nothing. It depends on what type of assets are in that marital trust, whether it's generating income, right? So if you fund the marital trust with a house that Jane is living in, there's not going to be any income for Jane to distribute. But if it's a marital trust funded with securities and they're invested in a way that's, focusing on income generation, there could be a nice income stream coming out of the trust to support Jane. Jane can probably also draw on the principal of the marital trust if needed. This is all dependent on how John set up his will, and there's quite a bit of flexibility as to how much access the surviving spouse will have to the assets in the marital trust. Now, when Jane passes, the surviving spouse passes away, the marital trust will be distributed per the terms of John's will. Typically, we can give the surviving spouse some control over what happens to the marital trust. We can give them a lot of control or a little control. It's really up to my clients. As we're drafting, we talk through all these questions. But once this plan is rolling, typically the marital trust will distribute per the terms that John had dictated. And in this case, my example, it will go out to their kids, their daughter and son, and now we have no estate taxes owing. So they have fully used both exclusions, right? Jane and John both had about $2 million of Washington estate tax exemption to use. We've used John's exclusion here on the marital trust, and that includes any growth in the marital trust. So if you invested the marital trust and it's appreciated significantly since John passed, those assets, all of them, let's say maybe it was 2 million when you funded it, but when Jane dies, that marital trust is worth 3 million. All 3 million is going to go out to the kids without being taxed in Jane's estate. Okay, so it's a pretty powerful way to leverage your exclusions, but you have to do some planning in your wills. You can't fix it after the fact if we don't have estate tax planning in your documents. All right, moving on. Any questions on this slide? Have I lost you?
Nope,
Anybody still with me?
Question number 2, can you put an IRA into a marital trust?
Yeah, great question. Yes, you can. I typically don't. I would be kind of my less preferred avenue, but it is possible to do it. And we do sometimes see that where we have really very few other assets to work with. Again, though, that requires some advanced planning. So if that's something we want to have as an option, I would typically have the spouse my clients update their beneficiary designations to make it possible for the surviving spouse. Like usually we would have the spouse be the primary beneficiary with the option to disclaim to the marital trust. And that would be set up in advance. So if we don't get around to doing that, or often what happens is the clients, we tell them what to do and then it doesn't get done. So we really we try to work with our clients to actually and with Allie or whoever the financial advisor is, to make sure the beneficiary designations are updated to be consistent with this plan here, because that's a really good point. And I don't put on these slides today, I'm not talking a lot about the fact that we've got assets outside of what is your probate estate. You've got maybe life insurance, you've maybe got retirement accounts that are not passing under your will. And if you want to be able to use those for funding a trust like this, we have to make some adjustments to your beneficiary designations, right? It's a good reminder. Any other questions on this one? Okay, I can't see a lot of people's faces, so I'm just going to continue on and hoping that. But the handful of you that I can see are nodding along like you're following, so that's good. All right, example 4, marital trust plan. This is very similar to example 3, but I just added a few more assets to the bucket here. So now we've got a $10 million estate. In this case, the surviving spouse, this is sort of a typical plan that we would see, would be inheriting 100% of the estate, but in this tax-saving marital trust. So it's not an outright gift to your spouse. It's a gift to your spouse in a very specific, special kind of trust. And the reason it's special is that typically if you're giving assets to somebody in a trust, that's not considered a gift outright to them, right? Like they don't have direct control over it. It's not like just handing them a check made out to them. Similarly, when you give to your spouse in a marital trust, it's not an outright gift to your spouse. Why does that qualify as a marital deduction gift that's not subject to estate tax? And this is where I mentioned the QTip. This is where that QTip comes in. So in this case, we're going to pick on John again. Poor John. Okay, John is first to die. His estate is $5 million. He has more than $2,193,000 of assets in his taxable estate, right? He has more than the Washington estate tax exclusion would allow him to leave to anyone other than his spouse or charity without paying estate tax. We are going to fund a marital trust, and we're actually going to fund it in 2 shares. So you see 2 buckets here. This is the Washington exempt portion of the marital trust, and we're funding it with a date of death value of the assets in that trust is $2,193,000, exactly his current Washington exemption. That will be an exempt trust. When Jane passes, she's the lifetime beneficiary of the marital trust, but when Jane passes, that will go out to the remainder beneficiaries, probably daughter and son, but could be other people as well. It will go out to those beneficiaries without being taxed in Jane's estate. But what about the other roughly $3 million, let's say $2,807,000 that exceeds John's available exemption? We're going to put that in the marital trust too, but we're going to make a QTip election. When we file the Washington estate tax return, we're going to make a very special election on that return. It's basically checking a box on the estate tax return, saying that this portion of the marital trust will be taxed in Jane's estate when she dies. Why do we do that? Well, we're deferring the tax until after Jane's lifetime. We're also preserving John's wishes about what happens. If he left this amount outright to Jane, he has no control over what Jane does with it. If she remarries or gets taken advantage of, something happens, that money is not necessarily going to go to John's kids, right? So by funding a marital trust, John could be as careful as he wants with giving Jane access to those funds and then dictating what happens to them, whatever's left of those funds after she passes. And in fact, she might have limited access to the QTip trust. That could be a bucket that we are, she has to get at least net income from the QTip trust for it to qualify for the marital deduction. So there's a few requirements for the QTip to be valid. The spouse has to receive the net income, must receive net income at least annually. The spouse must be the only beneficiary for her lifetime. There's a couple other sort of technical requirements, but those are the 2 big ones. And on the Washington exempt trust, this could be, we call this a marital trust, but I mean, it could be a trust for your kids or something too. All of these examples, I'm focusing on sort of the marital deduction planning, but this, you could easily substitute. This could be a trust where your kids were allowable beneficiaries too, because they don't necessarily need to meet the same requirements as the QTip trust. When Jane dies, if she has done no additional planning and no gifting, there's going to be a big estate tax bill for Washington, right? So her kids, basically, her estate will pay $840,000 of Washington estate tax. Do they need to pay that much estate tax? I would say probably not, because with some good planning, Jane could do some lifetime gifting and essentially eliminate or certainly greatly decrease the amount of estate tax paid at her death. She can gift from her own assets, the $5 million that she has here. She can also release an income interest in the QTip trust and do some gifting with the QTip. You can't gift directly from the marital trust to the kids, especially not a QTip portion of the marital trust. But there are some ways that we can creatively plan to move assets out to the kids. And this is assuming no appreciation. So of course, in my mind, It's probably going to be a larger tax bill than that, but no federal tax at this level. And I'm going to talk, if we have time, I'll talk more about federal estate tax, but because the federal estate tax exclusion is so high, fewer clients need to worry about that right now. And I'll try to save a few minutes at the end to talk about some upcoming potential tax law changes around the federal exclusion. All right, questions? I think we answered them.
None at this time.
All right, rolling right along. Post-mortem planning. There are some great opportunities to do some smart tax planning after a death as well. Ideally, you've done some good planning before anyone has passed away. But after, let's say it's a married couple, after the first spouse passes, there's a few things we really should be talking about. The first bullet here is just, it sort of seems like a no-brainer to me, but I honestly think there's a lot going on after death, and people have a lot to deal with, and it's not usually a rush. But before anything big happens, talk with an estate attorney, talk with your financial advisor, can help connect you with one if you don't have one, talk with your CPA, make sure that you have good advisors to help, especially if you're a higher net worth client, because there's some complexity to what happens next. And if we don't connect soon enough, sometimes we lose out on these planning opportunities to help reduce the amount of taxes paid.
Amanda, just to interrupt real quick, we do have a question from the audience, and the question is, how do you handle non-income producing real estate if income is required to be withdrawn from the trust?
Yeah, good question. And that does happen a lot. We have clients with big retirement accounts and a house and maybe a small bank account. And if we don't have an option to fund the marital trust with the retirement account, depending on how the beneficiary designations were set up, we will fund a marital trust with the house, and the house does not produce income. That is okay. If we have net income, it has to be distributed in the year earned to the extent we've made a QTip election and to the extent the trust agreement requires it. But if there's no income, then there's not going to be any distribution of income for the spouse, and that doesn't violate any rules. It's just the reality of the situation. Planning opportunities after a death, timely disclaimer. I talked a little about this in the context of disclaiming to the marital trust, but there's also the idea of actually disclaiming what you don't think you're going to need so that it passes to the children sooner, right? I'm assuming if you have kids that they're your remainder beneficiaries, but it might be a charity or whatever else. If the surviving spouse doesn't think that they need all of the assets that they're inheriting, they could conceivably disclaim to the remainder beneficiaries, but it has to be done in writing within 9 months of death. Filing a Form 706 estate tax return. This one I actually am putting it in here specifically because I know there's some folks here with professionals who are people don't always think about filing a 706 for an estate that's not federally taxable, but there are a couple of benefits to doing so typically. And if you're already filing a Washington estate tax return, especially, I encourage them to think about whether filing a 706 makes sense. One reason is to port the first spouse to die has this big exclusion for federal estate and gift tax, right? And when they die, that exclusion is whatever they don't need to use at that time can be carried forward to the surviving spouse. That is called portability. The federal exclusion is portable, but you have to file a 706 tax return for that to work. And that just means that now the surviving spouse can use their deceased spouse's unused exclusion on any lifetime gifts that they make. And when they die, they can also use it on their own estate. It will become a lot more important if the federal exclusion is cut in half or even more than that. And now we've got, at least your surviving spouse's exclusion is unlikely to be changed. That I can't guarantee it, but there's been, it seems unlikely we'll see any change to what happens to deceased spouse's share of their exclusion that they've ported for their surviving spouse. So filing an estate tax return has some benefit in that way. And I'll talk a little bit more too about the QTip aspect of this, but moving on to the next bullet here, allocating the GST exclusion. That's one that we tend to also see people forget, is that a GST exclusion, we each have our own GST. That's a generation skipping to the grandchildren. It's use it or lose it. And there's not much downside usually to allocating it to the marital trust if there's any unused exclusion that the deceased spouse had that they didn't use during lifetime. And one way it can be very valuable is if you fund the marital trust and then one of your children predeceases you, and now when the surviving spouse dies, that marital trust is going out to a grandchild. We'll be glad that if we didn't have GST available when surviving spouse died, because maybe surviving spouse did a bunch of big gifts to grandchildren, we will not need to worry about GST tax at that time if we've allocated GST to the marital trust when it was funded. So I usually at least raise that question, especially for larger estates. Different QTip elections for Washington and federal purposes. I see this a lot with that smaller estates. People don't think about this, but when you have a death, the decedent's assets get a step up in cost basis. That's an income tax concept, right? So if I bought my house for, I don't know, my parents sold their Lakewood home not too long ago. They bought their home for $150,000, maybe 40 years ago, and they sold it for, $800,000. That's a big, appreciation over time. If they had died when they owned that house, if one spouse dies and that was a community property asset, which it was, the house would actually, the surviving spouse would get a step up to the then fair market value of the house. So then we can forget about what they paid for it 40 years ago and whatever improvements they've made to it. Now the surviving spouse's basis is going to be the $800,000 that was the value at the date of death. You get that when the first spouse dies, but then you go and fund the marital trust with the decedent spouse's assets. And when the surviving spouse dies, you're not going to get a second step up on the assets that are in the marital trust. Not necessarily. The only way really for the marital trust to get a step up in cost basis on all of its assets, so let's say it owns a bunch of stock that's appreciated in value since the date of death, since the first spouse died, and now it's going out to the kids, and we don't get a second step up when mom dies because it wasn't in mom's estate, it was in the marital trust. We can actually fix that by making a QTip election for federal purposes, federal QTip election, so that it's included in the surviving spouse's estate for federal purposes, but it might not be included for Washington purposes. So we want the marital trust to be exempt from her Washington estate, but we want it to be taxed in her estate for federal purposes because we think she'll have plenty of exclusion to cover it. There won't be federal estate tax due. And we want the step up for the kids when mom dies. So I see this a lot. You have to file a Form 706 to do this, and you also have to include Addendum 1 with your Washington estate tax return to show that there are different QTip elections being made for federal and state purposes. That's a pretty technical concept, but I'm going to mention it because there are some folks here I think who should hear that, just be thinking about it, that it makes sense for clients in a certain bracket. A lot of our clients are in that like $2 to $15 million, $2 to $10 million range. This is a really common thing that we're seeing in planning right now. Strategic funding of the marital trust, that gets into a little bit what one of those questions was about. If we put a house in the marital trust, there's no income generation. So if we have choices, we definitely would like to sit down with the client, with the broker, with their financial advisor, with their CPA, and think about what should we put in the marital trust that we think is maybe going to be the asset that will appreciate most quickly, that will generate some income for a surviving spouse. Those are the types of assets we want to usually put in the exempt portion of the marital trust. And we talk about, if we have a choice, we can do some really great work with sort of how we invest each portion of the surviving spouse's estate and the marital trust. I encourage attorneys and CPAs to work together on these estate tax returns, also gift tax returns. Personally, I do not file these tax returns, but I look at them all the time. I work really closely with the CPAs that I have sort of my folks that I work with most often because they're very competent at estate and gift tax. And I think it's best when we both look at the product that we're filing. I see things that they maybe miss and vice versa. So they might be filing that return, but I always ask to see it before it gets finalized, and also to look at valuations, or sometimes I'm doing the valuations or taking the lead on those.
Amanda, we have a question. Question coming out. Does stock owned individually receive a stepped up basis when the first spouse and owner of the stock dies? What are the incidences that is not considered community property?
Yeah, great question. And it's obviously that's a bit of a complex one that's hard to answer without looking more at the details. But if you have an inherited asset, like an account that was funded completely with assets you inherited from a parent, for example, and you've kept it in your name throughout your marriage, you haven't added to it during the marriage, maybe you've reinvested like dividends that have been reinvested in that portfolio, but you haven't put more funds in that were community assets. Like you can't put your wages in that you earned during your marriage, then put them into your separate property account. When you start doing that, it starts to cloud the waters of what is separate and community. But a true separate property account typically is something you brought into the marriage that you've kept separate, or you inherited during your marriage and have kept separate. Those are the most common things I see. And if your spouse dies, you do not get a step up in cost basis on your separate property.
And then just to clarify one other item on that, just because an account is titled just in your name does not mean it is not community property.
Absolutely.
If it was
100%.
funded from salary and assets that were created during your marriage. So just because you may have never put your spouse on that account in title does not mean that it cannot be funded into these trusts unless it falls under these other areas. Thank you, Amanda.
Yeah, and actually I was going to say you can also use decedent's separate property is typically going to go into the marital trust. The default would be the marital trust will be funded with decedent's share of assets. That's all of their separate property.
Step up in cost basis, my bad.
Oh, for the step up in cost basis. Yeah, sorry. Yeah, the separate property, that's right. They always want to say, well, wait, I want the step up. It's like, we should talk about that before somebody dies so that we're not trying to, and usually there's not a dispute about those things, but sometimes there can be. So it's especially important if you have a blended family to be tidy with your keeping it. If you don't have a prenup, especially important to you to be thinking about your separate property staying separate if that's important to you. A big red highlight at the bottom here. This is my little self-serving a little bit, but I don't mean consult with me, but consult with your estate attorney before you retitle your assets, please. It happens so often that by the time the client comes to us, their broker, in an attempt to be helpful, has already retitled all of their IRAs and that joint tenant account, we retitled that in surviving spouse's name. And now half of their assets have already been put into the survivor's name, and it really limits what we can do in terms of our tax planning. So slow down. It's rarely a rush. Talk about it before we go off rushing to make changes. And I guess that's maybe targeted a little at my, not at you, Allie, but like in general, for those of you who do work with clients and are sometimes the first person they call, when something's happened and they want to make sure they have access to cash and all this. And I totally respect that. We can work with that, but we want to make sure we're being smart about what we're doing in terms of retitling things. Tax saving gifting tools. So I want to leave a few minutes for questions. I'm not going to go into too much detail on each of these. And by the way, my slides, we will share these after the presentation, but I don't know if you're like me, I get into these meetings and sometimes folks throw acronyms around like nobody's business. Here are a few of the acronyms I see a lot. And if you ever are curious about them, we can talk more about them. But I'm going to mention charitable trusts, CRTs, CLTs. Those are charitable remainder trusts, charitable lead trusts. I don't have time today to talk a lot about this, but there's some fantastic work we can do if you have charitable intent, especially if you have appreciated assets in your stock portfolio. You can, by funding a charitable remainder trust, and maybe you and your spouse or your kids are the beneficiaries for the first 10 years, let's say, of a charitable remainder trust. And that just means that the income will pay out to you for the first 10 years. And then after 10 years, that charitable remainder trust will terminate and go to charity. And the term can be different than 10 years. This is just an example. Why would you fund it with appreciated stock? But because if you go with that appreciated stock, if you sell it or have to do any diversifying, you're going to have that capital gains tax to worry about. But the charitable trust is actually income tax exempt. So you're essentially diverting the capital gains tax to a more charitable purpose while still retaining some of the income benefit, either for you or for your family members, of the stock that you've gifted for a period of time. And you can get basically a charitable deduction for that gift from income tax perspective when you make the gift. It also reduces your taxable estate. And I've started to see more of this, and it can be a pretty interesting way of planning. Intentionally defective grantor trusts. I'm not going to get into that today, but we do a lot of irrevocable trusts for children, for example, and we'll see intentionally defective simply means that it's taxed to the grantor from an income tax perspective. So you make a gift to this trust, you will continue to pay the income tax on the assets you gifted to the trust, but you've gifted those assets out of your taxable estate into a trust for your kids, let's say. Why would you do that? Why would you give things away? You're not going to get the economic benefit anymore, and you still have to pay the income tax? Well, because you're trying to push more out to your kids without having to make taxable gifts to them. And by paying the income tax on the gifted assets, it's like another way of supporting your kids without having to report, a gift, taxable gift to the kids and use up your exclusion. So we see quite a few of those lately. GRATs are less common with interest rates being a little higher, but a grantor retained annuity trust, a QPERT, a qualified personal residence trust, is a great option if you have a big, lovely house that you're planning on leaving to your kids and you don't have a loan on that house. That's something to explore maybe. Spousal lifetime access trust. These are really a tool that I would recommend more for the high net worth clients who are in the 15, 20 million and up range that have separate property, or that we can cleanly create separate property to fund that trust with. I'm sorry, I'm not going to talk about more about it, but just wanted to throw it out there as an idea. LLCs, we do a lot of LLC interests. So that comes back to this idea of minority interests. So really maximizing your exclusion. If you're federally taxable in particular, you need to be using your exclusion wisely. And you can get a lot done through discounting of minority interests in an LLC. You can put a lot of things into an LLC, income producing real estate. You can put securities into an LLC. You can put cash and then buy things in the LLC and then give your kids an interest in the LLC. And by doing so, actually do some very efficient gifting and using your exclusion. Annual exclusion gifts, we talked about $18,000 a year this year to each individual. That's cumulative through the year. So it includes any gifts you've made throughout the year. Direct payment of tuition and medical bills to the provider, not to your kids to then pay to their school, but to the school. Paying the tuition bill, paying the medical bill to the medical provider is not a gift to your kids, and it's a nice way to support your friends or family without having to report a taxable gift. Again, we're getting a little bit short on time. So income tax versus estate tax balancing, happy to talk more about this, but being a little careful that lifetime gifting, you don't get a step up in cost basis when you gift an asset during your lifetime. And capital gains tax could easily exceed the rate of Washington estate tax when you sell that appreciated asset. So being mindful that there's not just estate tax to worry about, there's also income tax. Qualified charitable distributions from IRAs, talk to Allie about that. All right, Allie, I'm going to start you on the, and being mindful of gift tax reporting requirements. File your gift tax returns timely. You don't file them, your attorney or your CPA will file them, but make sure that that is getting done. Don't sweep it under the rug, because what happens is now when somebody dies, we've got to go back and recreate, figure out what happened and catch up on that reporting, which is not fun. So there's also some other risks with late gift tax returns. So just keep up with it. Encourage your team to stay on top of it. We appreciate the occasional nudge on that too. So I'm not going to talk about the 2025 sunset too much. This is really for folks who have 7 million or more individuals, 14 million or more for a married couple. This is the idea that in if in 2026, January 1st, you will have half of the federal exclusion available that you have today. It will be cut in half. Federal estate and gift tax exclusion will drop from roughly 14 million to roughly 7 million per person. I think it's still not going to affect too many people, but if you want to talk more about it, talk to your state attorney sooner rather than later. Don't leave it till October of 2025. And who knows, with the election later this year, we'll know we should have a better idea of what's happening with this. But at this point in time, without Congress taking any action, we will see the estate and gift tax exclusion on the federal level be cut in half at the end of 2025. So do your planning early. All right. Phew. How did I do? Oh,
you did
1 minute
great,
to spare.
Amanda. Thank you. If anyone has any questions, could you please put them in the group chat, and we might be able to do a couple questions before we conclude.
All right.
Okay. Barring any questions coming through the chat, Amanda, do you have anything you want to say to close us out before we close?
Sorry, I ran a little faster at the end. I either lost you all or I did a really good job of explaining things. But there's one question Amanda had. Just to clarify, can you fund a marital trust with $2,193,000 or 50% of the joint assets, whichever is less. It really depends on what the document says. You can't overfund it. You can't put more than the decedent's share of assets into the marital trust. So if you had a $4 million estate and it was all community property, the decedent's share won't exceed 2 million. So yeah, you wouldn't be able to fund it with more than 2 million, with more than what the decedent owned. Good question.
Thank you. Okay, everybody, thank you so much for joining us. Amanda's information, this PowerPoint will all be sent out to everybody after our session. So feel free to reach out to either our offices at Financial Insights or Amanda with any of your questions. If any questions come up after, we have one more question. When I'm done, maybe we can stay on and answer. If you have any additional questions, please feel to send them off. Hopefully we'll see you at our next Wisdom and Wealth chat, and thank you so much for joining us. And then if you want to stay on, we do have one more question, but if not, we are concluded for CE, and we can stay on for a few minutes to do a few Q&A. So question from the audience: how does Social Security benefit factor in, if at all?
Yeah, it's not an asset in the taxable estate in the sense that we don't take a line item on the estate tax return for Social Security benefits. It does have an income, likely there's a survivor benefit for the surviving spouse, so it will become part of the equation when we calculate what income the surviving spouse will be receiving. And that might factor into how we fund the marital trust or other things, but it's not an asset of the estate.
Fantastic. All right. Thank you, everybody, for your questions. Thanks again for joining us. Thanks, Amanda, for your time and effort and wonderful presentation. We're very, very happy that you were here, and it was just such great information. Thank you so much.
Yeah, thank you. It's happy to do it.
All right. Take care.